Hello everyone. Today we are going to discuss about capital budgeting process. First, we are going to discuss, and then we will talk about the relevant cash flows related to this topic. So, in the previous lecture, we discussed about time value of money. There we learned how to calculate present values, future values, and how to calculate present value by using annuity, and how to calculate present value by using perpetuity. So because whatever things we have discussed in time value of money, so actually those things will be applied throughout this topic. So here we go, capital budgeting we are discussing now. So like what is capital budgeting? Actually, capital budgeting is the process of identifying, analyzing, and selecting the investment in the long-term projects. So for example, simply in simple words, whenever you want to invest maybe in the long-term project, so project could be maybe you want to invest in certain plant and machinery, maybe you want to invest in some building facilities, maybe you want to acquire a business. For example, maybe you are into you have already one business and now maybe you want to expand your business, so maybe you want to enter into the new market, and in that potential market, you are going to acquire a business, or maybe you are going to develop a product or even a product line. So all these things requires what? Capital budgeting. Like this is what I'm saying. So usually, guys, in capital budgeting, we have to take decision that should we invest into that or not. Mainly, we will use different techniques to evaluate your investment. Okay, like for example, maybe we may use net present value technique. We may use internal rate of return, that those things we will discuss. We may use payback period because we want to see how much profit we will earn on that investment. Profit in terms of cash flows, profit in terms of in terms of dollar and in terms of percentages. And we will also see how much time it will take to recover its cost. So all evaluations we have to do, these are quantitative method which we will apply. But overall, in capital budgeting, what we do, first of all, we need to identify, analyze, and then we have to select the investment, like which investment is better for the business. And here we are not talking about short-term investment, we are talking about long-term investment. So as I told you, long-term investment could be maybe in the plant and machinery, or maybe in acquisition of business, etc. Now, usually we have a stages in capital budgeting. Like whenever you evaluate or whenever you invest in the long-term projects, so usually which stages are there? Initially, I said, so maybe you will identify, analyze, and select, but we have 6 stages, okay, in capital budgeting. So stage number one is what? So whenever you are planning to invest in the long term, first thing you need to identify and you have to define what. So simply you need to identify the project, or you need to define the projects or programs, like it could be plant and machinery, it could be any decision maybe related to acquisition of business. So we need these. So identification and definition means say those projects and programs that are needed to attain entities objectives are identified and defined. Like simply, if your objective is maybe to expand your business, so maybe you will go for the acquisition of another business, right? So to expand quickly, so first we need to identify like which acquisition targets are available, like which companies you can buy. Or for example, if let's assume you want to reduce the cost of your product, then you have to decide here, you have to define here, you have to identify like which machines you should buy. Okay, which those machines which are more efficient, which can help you to reduce your cost. So this is what is called identification and definition. Simply here you will identify projects and program, so which will help you to achieve your objectives. So that could be maybe certain machines or certain businesses. Then second thing, once identification and definition is done, so once you have defined like which targets or which machine you want to buy, okay, so after that what? Simply guys, once it is decided, after that there is a search for that. Search means say what? As I told you, as I give you example, because this connection is really important. So first in identification and definition, you are trying to decide like what is your objective, and for to achieve that objective, which kind of decision you have to take, or which kind of investment you have to make. As I have given you example, for example, if you want to reduce your cost or if you want to become a low cost producer in the industry, so then obviously you have to select more efficient manufacturing machines which can help you to reduce your cost. So this is what is identification and definition. Like you're defining what you want. After that, what we have to search. Search means what? You have to look for the potential investments, like where you can invest now. So here, obviously, maybe you will decide certain machines. Okay, like machine A is available, machine B is available. So then first you will apply initial screening on that. Like, is this machine feasible for you or not? Right after initial screening, like if you think that, for example, machine A is having life of only 2 years, but machine B is having life, for example, 10 years, I'm just assuming. So maybe you want the machines, you want to use that machine which can be last for many years. It means in under preliminary evaluation, maybe you will eliminate this machine because this machine is having only life of 2 years. So you want to select a machine which can serve you, or which can obviously facilitate you for the 10 years. So now what will you will do here? After preliminary evaluation, maybe you have selected this one. Okay, like based on your basic idea, you are thinking machine B is better. So this is what is called search. Then after that, guys, after that, what you have to do, we have a information acquisition. Information acquisition means what? We have to identify like what are the cost of this machine, or we also need to do some benefit, like what benefits you will get through this machine. So here the cost and benefit of the project that pass the search phase are what? Enumerated. So what it means, simply you will do here, simply you will try to forecast like how much investment is required for this machine and how much cash inflows this machine can generate over the 10 years. So this information you need to gather, and this is obviously not easy stage because mostly it is based on your estimation, right or wrong, because this machine will, maybe you will use this machine for 10 years. So for investment, like how much cost you will incur to buy this machine, maybe this information you can get easily. The reason is that maybe you can check the price in the market, but how much inflows it will generate, right, in the future. So that is your estimate now. Maybe this there in the estimation you may have uncertainty also. Maybe today you are predicting that this machine can produce X number of units, and those number of units can be sold in year one, year two, and year three. But practically these things could be different. So that is why this is very difficult stage, like information acquisition. So here you are trying, what I'm trying to say, here you will get information about two things, like how much initial investment is required to buy this machine and what periodic cash inflows you would expect, you are expecting from this machine over the 10 years. And obviously, guys, not only financial information you need to consider here, you will also need to consider some non-financial factors also. For example, if you are going to buy that machine, what is the non-financial factor? Maybe you need to get some training, right, how to use that equipment, and you also need to get information how this machine can help you to satisfy your customers, or how this machine can help you to improve your product quality. So obviously these things only, not financially you are considering, you're also considering non-financial information also. And then next stage we have here, after information acquisition, the next stage is we have a selection. Selection means to say what? Selection means, guys, here you are going to apply certain models, like certain quantitative methods, simply to decide that this machine will give you profit or loss, or this how much time you need to recover the cost, whatever you are going to invest into this machine, how much time it will take to recover your cost. So here different methods you can apply. Maybe in selection you can apply. I'm just using the words. These method we will study by the way in future. So maybe you can apply net present value method. This net present value method is always based on cash flows, and it provides you information about profit, like how much profit you will get in terms of based on cash flows. Okay, and this will give you profit like in terms of dollar. Then we have an internal rate of return. So this is another technique which we will apply. Okay, to see like how much profit you can earn in percentage here. So this is also based on cash flows that we will see. This is one of the techniques. So by the way, both techniques you can use to measure the profitability. So NPV will give you answer in dollar, and this will give you answer in percentage. Then you can also apply payback period, accounting rate of return. Payback period will help you to understand like how much time it will take to recover your cost, right? And then accounting rate of return can help you to understand like how much profit you will get based on accounting profit, okay? Because net present values and IRR are based on cash flows, but accounting rate of return is based on accounting profit. And we'll see what are the differences between counting profit and cash flow. So here you have to just remember like what is selection. Selection means say you are going to employ certain models here, okay, just to see this project is feasible or not. Once project is selected, next stage you also need to answer that is called what? Financing. Financing means obviously maybe you if you do not have money to buy that machine, so then you need to arrange a finance for that. So then you will think like from where you will get finance. Maybe you will issue debt, I mean, say the bonds, loan notes, things like that. Okay, or maybe you will sell the stock of the company, shares of the company to get the money. So this is what you have to decide, or maybe you will get the money from your retained earning, or you will get the money from your operations, day-to-day operations to finance this, machine. So this is what is called next stage financing. And after that, once all these things are done, the last stage is called what? Implementation and monitoring. Okay, so what it means, implementation and monitoring. Once project are underway, means say once you will start investing, obviously, at that time you need to monitor also. And you need to monitor what you need to monitor. You should monitor that whatever spending or money you are spending, so that is within the budget, right? And whatever activities you are performing, those activities are completing within the time frame. For example, if you're installing machine, okay, so maybe you're making plan and in advance, right? Plan of what, like from this day, from at this point we will buy a machine, from this time to next this month, for example. So it will time to install that machine, and then from here to onward we will start using in production. So you have to monitor all those things, like whatever activities you have designed, those activities are being completed within the time frame, and whatever cost you are spending, so those costs are within the budgetary constraints. So this is what is called implementation and monitoring. So these are stages in capital budgeting. So just as a heading, I'm showing you one more time: identification and definition. We have a search, after that information acquisition, then we have a selection. So once investment is selected, then you will finance, and then you will implement and monitor. So these are the stages in your capital budgeting. Now here, the most important things which is really important here. So that are cash flows. Like when we usually, because as I told you, we will deploy different methods to evaluate our investment, right? Like NPV, net present value, or IRR. So for them, or for those techniques, we always need our cash flows. And by the way, we already discussed in the decision making, like relevant and irrelevant cash flows. But I'm here going to explain the main thing. So these cash flows will be relevant in your calculations here in the capital budgeting. Okay. So if you want to refer what are relevant cash flows, what are irrelevant cash flows in general, so I have uploaded that video already. So here we go, guys. So cash flows we are talking about. So usually regarding capital budgeting, so here, so we can divide, okay, our cash flows into three categories. So some cash flows will be the part of net initial investment, and second category of cash flows are called annual net cash flows, and third category is called what? Project termination cash flows. Usually this initial investment, net initial investment, this cash flows or this money you will spend at the start of the project. And project termination cash flows, these are the cash inflows mostly which you will get at the end of the project. Okay. And then in between, obviously, for example, a project is having a life of 5 years, let's assume. So I told you we will write always like year 0, 1, 2, 3, 4, 5. I told you last time like the concept of timeline. So investment we always write in year 0 as a outflow, And project termination cash flows will be written in the last year, in between year 0 and year 5. So these cash flows are called what? Annual net cash flows. So that we will see, okay, how it is going to work. How would you calculate? So here I'm not explaining any method. I'm not explaining like what is net present value or IRR. No, today my discussion is mainly about cash flows, like which cash flows we have. So first category of net initial investment. So which cash flows will be the part of this initial investment? So here we go. So there will be a three things. Then I'll show you each things one by one. So first, net initial investment. So net initial investment, first thing it will include what? Cost of new equipment. Like what it means. So obviously when you will invest, obviously initially maybe you have to invest in non-current asset. Right around the cost of the equipment, we always assume. So this investment is a non-current asset. And please remember, investment usually we write, obviously, we should write as a negative value in the brackets, right? So first thing, first cash flows under the net initial investment. It has three components actually, one, two, and three. So first component of net initial investment. So that is called what? Cost of new equipment. And in exam question, he will tell you that, for example, company is going to buy a machine or maybe plant, etc. And the cost of plant is, let's say, $100,000, $200,000. So that is what is called cost of new equipment. And obviously, it is going to be your outflow. And we always assume, okay, so this equipment obviously have a non-current asset, and in future maybe we will depreciate this non-current asset also. So depreciation effect will come. So here we go. First thing is what? So net initial investment will include first a cash flow, which is called cost of new equipment. Second cash flow is what? I'll show you then with the help of example. Second is what? Second is what? It may include initial working capital requirement. So initial working capital requirement, mostly in your capital budgeting, he will use this word, like investment in working capital. Actually, we assume this investment is in the current asset. Okay, this investment is in the current asset like inventory, receivables, etc. And third, cash flows. And obviously, initially it will also be outflow. So then third is what? Third, cash flows could be after tax proceeds. This is really important. After tax proceed from disposal of old equipment. So what it means? For example, if your project is starting from this point, okay, year 0 to onward, maybe you have some old asset with you. So that old asset you are going to sell at this point. Okay, old asset which you have with you. So you're going to sell, okay, at this point. So whatever money you will get, okay, from the disposal of old equipment at the time of start of the project. So that proceed we need after tax, because tax effects are really important. So we will always consider tax effects. Okay. So we need after tax proceed from disposal of old equipment. So that we also need, and mostly that would be inflows. Okay, so that could be enclosed. So then once you will net off these three values, cost of new equipment. Now I'm going to show you these things in calculation. Cost of new equipment plus net working capital requirements and plus or minus after tax proceed from disposal of old equipment. If I'll do net of these three values, if I net of these three values, this is called what? Net initial investment. Okay, and this net initial investment, I will write as a outflow in year 0. Okay, let's have a look first. Then I'll come to the annual cash flows. Then I'll go to the project termination cash flow. So net initial investment, this is how information will be given to you. So I'm going to show you here. For example, here we go. Let's assume, for example, we are assuming there is a company and that company is having 40% tax rate. Okay. And this is the information is available for a new investment. Okay. What is information? They're telling you, for example, maybe you're going to acquire a machine, let's assume. They're saying that, or maybe you're going to erect a factory. So they're saying you have one project, by the way. So the project will require, this is the first information. For example, this project will require an initial outlay means outflow of 500,000 of new equipment. So actually, this is what is the cost of new equipment. And I told you it is always be a outflow for you. Then second information he told you, for example, they're telling you the company expects to commit $12,000 of working capital for the duration of the project in in the form of increased account receivables and inventory. Actually, this is the investment in the working capital. So whatever money you will invest today, maybe in, for example, in shape of inventory. So that is called investment in working capital, and that is also considered as outflow. And we have a assumption here in the capital budgeting. What we assume, whatever money we will invest in the working capital, we assume this will be recovered at the end of the project. This is assumption actually. This will be recovered at the end of the project. So it means this investment in working capital, which you are writing as a outflow today, so it will be written as inflow also, but as a project termination cash flows when you will complete this project. Once this project will be over. So far, once we'll go there, I'll tell you what it is. So it means there is assumption that this working capital will be recovered. So, but here you have to just consider it as an outflow. We will consider it as an investment. So it means first investment, it was under non-current assets. Second investment, it is under current assets. And then third thing he will tell you, for example, if he told you, for example, now just I'm assuming because here direct values are given, but I'm just assuming. For example, he told you the company is having a old asset. That asset is also sold at the start of the project. Old asset you sold when at the start of project, and you sold it for what? For 5,000. So this is the sale price. And if you do you remember, so what we need, the third cash flow here, we need after tax proceed from disposal of old equipment. Now we are going to work with it because cost of equipment is given straight away. Investment in working capital will be given straight away. So this you have to calculate after tax proceed from disposal of old equipment. Now this we are doing now, okay? So for that, he will tell you information. He will tell you, for example, old asset is sold for example, 5,000. This is sale price. And he will tell you also the tax base of the asset. What is tax base? Tax base means say usually in accounting, we have carrying value, right? Carrying value is what? Cost minus accumulated depreciation. Okay, in accounting, usually this is called carrying value of asset, right? Once you will take the cost of asset and you deduct accumulated depreciation, this is called carrying value. So then what is the tax base? Tax means say cost minus accumulated depreciation, but this depreciation should be calculated as per tax rule. And by the way, here you are not required to study tax rules. We will simply apply a straight line method that I'll tell you what changes are there. Okay, but simply assume here, for example, cost, tax depreciation, you also know, assume. So once you will take cost minus accumulated tax depreciation. So this is what is called tax base. Tax base is how you got cost minus accumulated tax depreciation. Okay, so this is called tax base. So tax base, I can also say this way, this is the value of asset showing as per tax record. Okay, so for example, you sold the asset for 5,000 and the asset's value, which is showing in the tax record is 20,000. See, it's simply like that. As in accounting, we calculate gain or loss. How we calculate gain or loss? We always take sale price of asset minus carrying value of asset. Okay, the result would be gain if answer is positive. Our result would be loss if answer is negative. Like when you apply the formula, selling price minus carrying value. So same here in tax in capital budgeting, we will also apply the same thing. We'll take first selling price. Let's say we sold the asset for 5,000, and then we'll deduct carrying value. But this carrying value is called tax base here. Okay, tax base means say it is the cost minus accumulated tax depreciation. So that is, let's assume 20,000. It means this asset was showing uh, uh, at 20,000 in the tax record, but you sold it for 5,000. So definitely once you will apply disposal value minus tax base, if answer is negative, it is called what? Loss on disposal. Loss. First calculate the loss. Once loss is calculated, then what you have to do? Then you have to take after tax effect on cash. Because if this is the loss, this loss you will multiply with the tax rate, a tax percentage. you will get tax saving. But if this is the gain, so gain will be multiplied with the tax percentage. This is called what? Tax payment. Right or wrong? Saving should be written as a inflow and tax payment should be written as a outflow. So usually, obviously, guys, when we sell asset, so we may have a gain or loss, right? On gain, technically you have to pay tax, right? And on loss, you can claim tax saving. So this is what we have to do. Step number one, under third cash flows, because here we are working with what? After tax proceed from disposal of existing asset. So first thing what you will do, first calculate gain or loss. First calculate the gain or loss. And gain or loss, how you will calculate? Disposal value, take from the question, minus tax base will be given in the question. If tax base is not given, we will assume it is zero. But if it is given, deduct it. And the result would be what? Loss or gain on disposal. And after that, there is a second step also. Then in second step, you need to calculate, after tax proceed, after tax proceed, how you will calculate. So you will take what? Disposal value, because this is what you are receiving, 5,000, right? This 5,000 you are receiving. And then you will do here plus or minus. Plus or minus of what? Plus or minus of tax on gain or losses. And how you will calculate tax saving on loss? First, you will take disposal value plus or minus. If you have a loss here, you will multiply with the tax percentage. This will give you tax saving, right? So if you have a tax saving, you will here add, because saving is like an inflow. But if you have a gain here if you have a gain, that you will multiply with the tax percentage. So that will give you a tax payment. If it is tax payment, then you will deduct from here, from the disposal proceed. Now you will take disposal proceed. So what is the format here? Step number one is what, guys? Step number one here is first calculate the gain or loss. First calculate what? Gain or loss. This is how you will calculate our gain or loss. And after that, you will write disposal proceed. If you have a loss here, so you will take add tax saving on loss. Take the amount of loss, multiply by tax percentage. If you have a gain here, so you will minus here, not add, then minus tax payment on gain. Write the amount of gain, multiply by tax percentage. So now you will, once you will net off these things. So this is called after tax cash inflow from disposal of old asset. Actually, this value I need. So what I told you, simply first calculate gain or loss. How you calculate gain or loss? Sale price minus tax base equals what? Gain or loss. And second step, what you have to do? Just write sale price. Okay. If you have a loss, add tax saving on loss. And how you will get? Put the amount of loss here, which you will get step number one from here, multiply by tax percentage. But if you have a gain, then deduct tax payments on gain. And how you will get tax payment? Take the amount of gain, you will calculate from here, multiply by tax percentage. So this will give you what? This will give you actually, this will give you what? Final after tax proceed, which we need. Proceed from disposal of old asset. This is what we need, okay? In the step number one, actually. Actually, this is what we need. This is what after tax proceed we will plug with the cost of new investment, the cost of new equipment, and with the investment in the working capital. Now see here, I'm assuming here, please have a look. Don't break a sequence here. Sequence is really important. Okay. As I told you, under initial investment, so you have a three cash flows, right? Which three cash flows? We have here cost of new equipment, that is 500,000. We'll take this 500 plus investment in working capital, that is 12,000. That we will also take. And then we will pick this value after tax cash inflow, 11,000, right? So this will give you initial investment. So it means 500,000 was investment in the new equipment. Then you have a 12,000 investment because it's written negative, right? Because this is also payment in new equipment. You paid for that. This is also payment because you invested in the working capital. And this is your inflow. Why inflow? Because it is after tax cash inflow from this, from the disposal of old asset. So now what we'll do, 500,000 was the negative value, 12,000 was investment in the working capital, that's also negative value, and this is the positive value, 11,000. If you will do plus minus, so 500 and 1,000 will be final negative value, and this will be written as investment, as outflow in year zero. In year zero. I hope so it is clear. Now, guys, we are moving to second type of cash flow. The second type of cash flow is annual net cash flows. Annual, as I told you, it will start usually from year one to onward, right? Okay. So that is annual, like what annual you are receiving. And annually, it may include these things, please. Annual cash flow, look at it first. Annual net cash flows. It will include these two are important things. First, you have to calculate after tax cash collections. After tax cash collections from operations, and how it is calculated. And they're saying excluding depreciation effect. Yes, because depreciation effect we will take it later. Okay, so after tax cash flows means say what? I'm just giving you a rough idea, guys. For example, let's assume this is year one data, year one to eight data, or year one to five data, for example. Means say the same data is in year one, two, three, four, five. Let's assume this is what I wrote year one to five. So, for example, he may tell you here sales, right? Sales, deduct, for example, relevant cash flows, whatever relevant. Maybe operational cash flows could be maybe you are investing in material, labor, maybe variable overhead. Maybe you are investing in, you have some opportunity cost, because opportunity cost is also relevant, you know. So you will deduct, for example, sale is 100. Okay, these costs, all these costs are, for example, $80 deducted. Okay, so you have $20, and now this $20, please remember, in this expenses you will not write depreciation here. Don't write depreciation, okay? Because depreciation effect we will take later. And now we have a $20, and this $20, for example, you have a tax rate of 40%. So we'll take tax 40%, which is, let's assume, 8. So after tax will be what? $12. This is what they are saying, after tax. And usually in your exam and CMA, specifically, he will not tell you material, labor, variable overhead, etc. He may give you directly a net cash inflows, maybe this value directly, $20, and then just simply you have to deduct tax, whatever rate is given. This will give you after tax. This is what is the first line it means. After tax cash collection from operations. Understood? And then what you have to do? In that, you have to then, in that after tax cash collection, then you will add this thing, what? Tax saving from depreciation deductions. So what is depreciation deduction? For example, as I told you guys, in initial investment, first you have what? Cost of new equipment, right? I told you that investment we always assume, obviously, even equipment word is not there. If we told you initial investment, so we'll assume that is what? In non-current asset. And that obviously investment should be depreciated, right? And due to depreciation, obviously, guys, because due to tax depreciation, actually, so you will get, obviously some tax saving. Why? Because if you will write depreciation as expense, it will reduce your taxable income, right? It will reduce your taxable income. And if your taxable income will be reduced, obviously you will get some saving on that, tax saving. So that is why it's called what? Tax shield, that depreciation tax shield. Okay. So for that, what it is treated as inflow. The reason why it's treated as inflow, because due to that depreciation, even depreciation itself a non-cash based item. But due to that depreciation, you have a tax effect. You will get saving. Because this, once you will write this depreciation in the expense, it will reduce your taxable income. And if taxable income is reduced, so tax saving you will get. So this tax saving we need only. Okay, and how we will calculate tax saving? So for tax saving, first we need to know what's the amount of depreciation. And then depreciation we will multiply with the tax rate or tax percentage. Now this is called tax saving. And this tax saving is also called depreciation tax sheet. For example, let's assume our depreciation, I'm assuming, let's assume we have a depreciation of 10,000. We have a tax rate of 40%. What I'll do, simply I will take depreciation amount, multiply by tax percentage equals tax saving. So depreciation is 100,000 or 10,000. Tax rate is 40%. It means tax saving is going to be 4,000. And this should be written as inflow. So this is what is the second thing here. Understood? So two things you will calculate, and now I'm going to tell you here. What is the first thing under annual cash flows? First, take operational cash flows, deduct tax from there, and make sure in this operational cash flows depreciation is not included. And then what? Take the depreciation amount and then add what? Multiply with the tax percentage. Whatever saving you will get, add that saving with this cash flow. Okay, how it is going to work? I'm just going to show you example here. Small just data quickly. For example, this is what information is given. Let's assume. Okay. For example, they told you here a project is expected. Same investment, which we invested initially. So it's the same project. For example, it is expected to generate $100,000 annually. Annual means this is operational cash flows. Okay, from ongoing operations. 100,000 annually. Maybe if that project is having 5 years life, let's assume so in year one also, in year one you will get 100,000. In year two, you will also get 100,000. In year three, also 100,000. Or maybe in exam question, he may tell you different cash flows. For example, he may tell you in year one, you're getting 100,000. In year two, you're getting 200,000. In year three, you are getting 300,000. It can be given that way. But here we are assuming every year you are getting 100,000. And then once we have this information, please remember this cash flow is without depreciation. Okay, then we should know what is the tax rate. Let's assume tax rate is 40%. What I'll do, I'll write annual cash collection, which is 100,000 annual. And okay, and from there I'll deduct income tax expense because on this profit I have to pay tax. Okay, so what I'll do, I'll take this profit times 40% this tax payment I will deduct. So this is called after tax cash inflows from operations. And you are usually CMA exam, this will happen like that. Only he will tell you cash flows, annual cash flows, tax rate, just deduct. Right? Annual cash flows, deduct tax effect from it. This is will give you after tax cash flows. And after that, you need to add here. Now, in this amount, you need to add here tax saving on depreciation. For that, you need to know the depreciation value and multiply with the tax percentage. So this will give you tax saving on depreciation or depreciation tax shield. So for example, for that, you should know first depreciation. Let's assume I'm assuming here. You know, in my previous example, we assume we invested in the non-current asset or in the equipment. The cost was 500,000. So that value actually should be depreciated. And please remember, whenever you calculate depreciation, this is a really important point. Usually, in accounting, what we do in accounting, usually we do when you calculate depreciation expense in accounting, I'm saying now. So you will take cost of asset minus residual value divided by life. Please remember, when you calculate tax depreciation, so don't deduct residual value, even it is given. So put residual value 0. The reason the tax authority, they don't accept this uh, as a residual value. The reason tax authority says it is your estimate, right? So that is why simply whenever you calculate depreciation in this concept or in this topic, simply you have to take cost over life, or you can take cost multiplied by depreciation percentage, but don't deduct residual value. Okay, this is important point here. So for example, let's have a look. Let's assume the new equipment is projected to have salvage value. Salvage value means a residual value of 50,000. We will ignore it. And will generate 62,500 depreciation. How we got? Because cost was how much initial investment? 500,000 in the non-current asset. Simply we are dividing with the 8 years. Let's assume if that project is having 8 years life. So we will deduct a depreciation expense of how much? 62,500. See, we didn't deduct here residual value. We will not deduct. Even it is given as a 50,000, but don't deduct. Okay, so this will give you simply depreciation of 62,500. I hope so you know how to got it depreciation. Cost over life. Then what? The annual saving. How you will get now tax saving on depreciation. Once you will get this depreciation per annum, multiply with the tax percentage. So you will get tax saving per year. So tax saving, for example, tax percentage is 40%. So depreciation amount is 62,500 multiplied by tax percentage equals tax saving. So tax saving, for example, is going to be how much? Let's assume 25,000 because amount of depreciation is 62,500. Okay, multiplied by tax rate is 40%. So this will give you what? 25,000 per year tax saving. And now this tax saving plus this after tax cash inflows from operation, we will add. So this is what is called now annual cash flows. annual cash. So this was 60,000, for example, from year 1 to it. This is 25,000 tax saving. If I'll add these to 60 plus 25. So this is going to be my annual net cash inflows from the project. 85,000. Understood? So two things you need. What you need? Simply first you need after tax operational cash flows. Then you will add tax saving on depreciation. So this is called what? Annual net cash inflows from the project. Is that clear, guys? Now, guys, we have here third cash flows. Third thing, we are done with this. We are done with this net initial investment. Net initial investment, I told you we will have three things, right? We three things we will have: investment in non-current asset, plus investment in working capital, minus what? After tax proceed from disposal of old asset. And then I told you about annual net cash flows. I told you here you will have two cash flows: after tax operational cash flows plus tax saving on depreciation. And now I'm going to tell you about what? Project termination cash flows. Project termination cash flows means say, obviously once project will be terminated, means say once it will be ended. So at that time, whatever cash flows you will receive, that is called project termination cash flows. And here usually in at CMA level, please see, I'm just explaining with respect to your exam only. Otherwise, NPV or cash flows are very big topic. Okay, so I'm just telling you required things which are important only for your exam. So project termination cash flows, usually it will include what? First thing, it will include dispose after tax disposal. After tax disposal proceed from new asset. New asset, you bought it here. One asset you bought, right? Cost of new equipment, this one. You bought it here. We will assume this asset will be sold at the end of project life. And he will tell you sale price for that or residual value for that. Okay, and second thing, what we will assume here. So it means we need after tax proceed. And similar, we will calculate after tax proceed if as we have calculated at the initial stage. But at initial stage, we were dealing with the after tax disposal proceed of old asset. But here we are selling new asset which we bought it here. That we will sell it here. And second thing, we will write it here: recovery of working capital. Working capital we also invested at the start, right? We invested at the start at this stage here. It's written here, right? At this stage. So that working capital we will assume it is recovered. It will be recovered, we will assume. And please remember here, we will take this untaxed value. Don't take any tax effect in this recovery of working capital. So two things are there, guys. Which two things? Number one, in project termination cash flows, the first thing would be after tax proceed from disposal of new equipment. The equipment which you bought at the start of the project. So that we will assume now it will be sold. And second thing, we have to take a recovery of working capital, and this amount you will always take untaxed. Understood? Untaxed. So here we go. How it is calculated, I'm just assuming data here. For example, these are project termination cash flows. First thing he told you, for example, new asset which you bought at the start of the project. You sold it for 50,000. You sold it for what? 50,000. Let's say this is the sale price. So I'll do the same process. What I'll do, first I'll calculate the gain or loss. First I'll calculate gain or loss on disposal. Similar way as we have done earlier. Gain or loss, how you will calculate? You will take disposal value. For example, I sold this asset for 50,000 minus tax base. I'm assuming a tax base is zero. Why? Because I'm assuming that this asset is 100% depreciated. But if you have any tax base, you can deduct that one. Tax base, I told you what? Cost minus accumulated tax depreciation. That is tax base. But here it is assumed that asset is 100% depreciated. So there is no tax base. Okay. So tax base is zero because our asset is 100% depreciated. So I'll take sale price minus tax base, which is zero. So it is called gain on disposal now. Now then next what? Second step also is the same. I'll take this sale price, second step now, because I'm going to convert after tax now. I'll take sale price, which is 50,000. Why it's written a tax base gain on disposal? Because sale price and gain is the same value, right? Actually, this value should be here, sale price here. This value should be sale price. Okay, sale price. And then what? Less tax liability on gain, because this is the gain. Na? If on gain, if you have a gain, so you will pay tax. Simply you will take the amount of gain multiplied by percentage of tax. So you will get tax payments. But here if you have a loss again, so loss will be multiplied with the tax percentage. So you will get tax saving. So tax payments you will deduct here if you have a gain. And tax saving you will add here. And how you will get tax saving or tax payment? Simply take a amount of gain or loss, multiply by tax percentage. You will get tax payment or tax saving. As I told you, if you have a gain, you will get tax payment. If you have a loss here, so you will get tax saving here. And tax saving will be added. And tax payments on gain will be deducted from here. So we'll take tax basis minus tax liability equals what? After tax cash inflow from disposal. This is what I need. This value plus recovery of working capital, because we need two things now. We need after tax proceed, we calculated, yes, after tax proceed from disposal of USA, we got this value, but we also need to add recovery of working capital. Working capital we invested at the start of project, for example, it is 12,000. This will be recovered now. So now I'll add these two cash flows. After tax proceed from the disposal of new equipment plus recovery of working capital. Please don't do any adjustment for the tax related to working capital, because it is not taxable, okay, as per tax law. So now if you will add these two, this is called what? Project termination cash flows. And for example, this will be written in the last year of the project. If project is having 8 years life, so year zero, you will write year 0, 1, 2, 3, 4, 5, 6, 7, okay, and 8. Okay, you will write year 1 to 8, or I can just tell you here. For example, I'm just assuming value termination cash flows are 42,000 here. And what was the operational cash flows with tax saving? It was 85,000. And initial investment was 501,000, I believe. And let's assume project is having 8 years life. Let's new. Yeah, initial investment was 105. Now how you will write cash flow in the timeline? So you will write it a year, for example. Because I'm assuming here years you will write for 0, then 1 to 8, and then I'm putting here 8 also separate one thing. Why? I'm telling you. In year 0, you will write initial investment, which is 501,000. And here you will place project termination cash flows. Project termination cash flows, which are, for example, 42,000. And in year 1 to 8, operational cash flows, which are 85,000. 1 to 8 means in year 1 also it is 85,000, year 2 also 85,000, 3 also 85, 4, 5, 6, 7, 8, and so on. Okay, up to 8 years. This is the one way to write. Another way is what? Write years this way. Write year 0, 1, 2, 3, 4, 5, 6, 7, and 8. In that scenario, you write initial investment here 501,000. Annual after tax cash flows, you will write it here. Annual after tax cash flow, you will write it here 85,000, 85,000, 85, 85, 85, 85,000, 85, and 85. In every year you will write 85,000. And then you will place project termination cash flows. Project termination cash flow you will write only in the last year, which is, for example, it was maybe 42,000. So now this will give you net cash flows. Net cash flows what? Equals net cash flows. For example, here 501,000. Here 85, 85, 85, 85,000, 85,000, 85,000. In the last year, you will add these two value. Whatever you will get, this will be your inflows in the last year. This is how you will place the cash flows in the timeline. This is the way to place also. If you have even cash flows are uneven, even means the same or different. But if you have even cash flow, this is the quick way to do it. Right here 0, 1 to 8, then 8. 1 to 8 means these are operational cash flow. This is termination cash flows. Okay, guys. So this just I told you what are cash flows here. And obviously, if your project is having inflation effect, that should also be considered, as we are considering tax effects, right? Because inflation is also important. Maybe something you may, for example, you may buy today for $100. After 5 years, maybe if same thing you will buy for this project, even maybe you will pay 105,000. So inflation should be incorporated, right? So that is, by the way, in CMA won't be tested. So there was so many scenarios are there even for inflation. But for CMA, I believe this will be the enough information regarding cash flows. From next session, I'll start by using these cash flows, how to calculate NPV, IRR, and payback. Understood, guys?